Hey everybody, this is going to begin part 2 lecture of chapter 1. However, when I finished the part 1 lecture, I realized that I pressed stop instead of pause, and so I couldn't get the part B part of this example exercise in the first lecture. So we're going to start out with this example exercise where we left off with part 1 of chapter 1. So what I'm going to do is I'm going to pull up an accounting equation here in Excel to kind of mirror what we're doing on the slide here. And it says, John Hughes is the owner and operator of Eurostar, a motivational consulting business. At the end of the accounting period, December 31st, Eurostar has assets of $800,000 and liabilities of $350,000. Using the accounting equation, determine the following amounts. Well, you see, if you set it up just like the accounting equation, assets equal liabilities plus owner's equity, and you solve for owner's equity, then for part A, the answer is $450,000. Then in part B, it says now they want us to find owner's equity at the end of 2016, assuming that assets have increased by 130. That means at the end of 2016, assets are now $930,000. And it says assume that liabilities decreased by $25,000. That means that liabilities are now $325,000. And then we're going to solve for owner's equity. So you can see in Excel what I'm doing is making a formula, and I'll say assets minus liabilities to come up with that number of $605,000, and that would be the answer for part B. Now that's for our next problem solve. And then you see here on the next slide, it does show the answers in the example exercise. For every example exercise in the chapter, you have 2 homework problems that are going to mirror that example exercise. So you want to be sure and study those example exercises. Now, if you're following along in the book, we're on page 10 and right around page 10, I think at this point, for business transactions. And a business transaction is a change. It's an economic event. It's something that happens, and it's going to directly change the entity's financial condition. What I do in class is I will exchange a marker for a highlighter or a highlighter for a stapler, and we'll talk about that exchange, because if you exchange one thing for another, then it would change your account status. In other words, if I exchange a marker for a stapler, that means that my stapler inventory would go up and my marker inventory would go down. So every transaction is going to affect your business in a different way, and you have to figure out both sides of that transaction. So we'll start here with transaction A, and on page 10, the book tells us that Chris Clark is going to start a brand new business called Net Solutions, and we're going to fix computers. He's going to work on people's computers, and they're going to pay him money. And eventually he wants to open a store, but at first it's going to be a service business. And then I'm going to pull up an Excel spreadsheet here that's going to kind of mirror what we're doing as we work through the chapter, so I can show you what's happening here. Okay? And once again, you see assets equal liabilities plus equity. And I'm going to make this a little bit bigger here so you can see that. And what we're going to do is we're going to see how these transactions affect different accounts. Now, one thing you'll notice in this particular chapter is that we have assets. We have 3 different assets: cash, supplies, and land. We're going to have one liability, which is called accounts payable. Our capital account is actually going to have Chris Clark's name on it. Chris Clark, comma, capital will be the name of his capital account. When the owner puts money into a business, we're going to use an account called capital. And then for the owner's withdrawals, I'm going to actually have an account called Chris Clark Drawing. Sorry, it's taking a minute. And then I'm also going to put a minus beside that, because when we add the amounts down here, those amounts are going to have a minus in front of those. Then we have fees earned. That's going to be our revenue account. Wages expense, rent expense, supplies expense, utilities expense, and miscellaneous are all expenses, and we'll talk about those expenses in a minute, but the expenses are going to be the cost of doing business, the cost per month of earning the revenue. All right, so let's look at transaction A. It says on November 1st, Chris Clark deposited $25,000 in a bank account in the name of Net Solutions. So what we're going to do is we'll look at these accounts and we'll figure out which accounts are affected. So when the business gets cash, then $25,000 is recorded in the cash account because we just got cash. Then when the owner makes an investment, what you're going to do here is you're going to increase the capital account because the owner just made an investment. And when the owner makes an investment, you always have to make a note of that in the capital account. Next is transaction B. On November 5th, Net Solution paid $20,000 for the purchase of land. So Chris Clark has found some land he wants to use in the future. But what happens to cash when you see this word, paid? Whenever you see paid, that means that cash goes down. So you'll type negative $20,000 because cash just went down, and that means that at the end of the day on the 5th, we're left with $5,000. You'll see row C here is $5,000, and that's just a running balance of how much we have left in row C. And then also, the day that we bought the land, we paid cash and we got land. So our land account increased by $20,000. And you can see here pretty easily that all your assets, cash, supplies, and land, equal your liabilities plus your owner's equity. And throughout this problem, that's going to be true. If you record each transaction correctly, then the accounting equation will be equal. Then we're going to look at transaction C. It says Net Solution purchased supplies for $13.50 and agreed to pay the supplier in the near future. It says the liability created by a purchase on account is called accounts payable. So we just bought supplies, $13.50, but you notice in this sentence it doesn't say that you paid cash. It says that we agreed to pay the supplier in the future. Therefore, we're going to set up an accounts payable because we're going to pay them later. And then you see here on the next row, we're going to balance that out. I'm going to see here if I can freeze my pane so I can see it better. All right, so now we're ready for transaction D. And the slide here tells us that whenever you earn money, that is called revenue. So you want to remember that. Transaction D, on November 18th, Net Solution received cash. Very important two words. We received cash of $7,500 for providing services to customers. So we got cash because we earned money. So we got $7,500 and we earned, here's a revenue account, fees earned, $7,500. And in Chapter 1, revenue accounts are going to increase capital, so we put that under the umbrella of equity in this chart, and all the expenses are going to take away from capital because we're going to match the expenses against the revenue, and so we'll put a minus beside the expenses when they happen, and you'll see how that'll work in the chart in a minute. Now we're going to move on to transaction E. First, they're going to tell us a few more things about revenue accounts. It says when we provide service, it's called fees earned. If we sell stuff, it's called sales. If someone pays you rent, that's going to be called rent revenue. If the bank pays you interest, that is interest revenue. Also here, they're going to mention accounts receivable. And in this particular problem, Chris Clark does not have an accounts receivable in Chapter 1. However, it is a claim against a customer. It happens when a customer owes you money, and we will look at that in the example exercise. Transaction E introduces expenses. And the definition the book's going to have for expenses are assets that are used up in the process of earning revenue. Transaction E, it says Net Solution paid the following expenses. And so what we're going to do is we're going to record all those expenses here on our chart. And they've added up the cash here for us in row E. We paid out, so I'm going to put negative 3650. We paid out cash, and then we paid for the following expenses. I'm going to move this on over. Wages expense, and we'll put negative 2125. The expense account is increased, but on this particular chart, the expense account is a negative account because it's going to be counted against fees earned. Rent expense, 800. Utilities expense, 450. And miscellaneous, I forgot the minus there, miscellaneous, and miscellaneous is negative 275. And that is paying our expenses. Transaction F says on November 30th, Net Solutions paid, there's that four-letter word, paid creditors on account. So you know that when you see the word paid, our cash goes down. So we paid $950. So immediately you know our cash goes down. The next question is, who did we pay? Well, we paid our creditors. Liabilities are when we owe money to other people. And so our creditors are the people that we owe money to. So at this point, we owe $1,350. But if we pay $950, that means that we owe less, and that means now our balance below here is going to be $400. Transaction G. It says that Chris Clark determined at the end of the month that the supplies on hand are $550. Well, we started out with $1,350 worth of supplies, and at the end of the month, they're $550. Well, accounting 1 does not account for theft, and so what has happened is that those supplies have been used up. $800 worth of supplies have been used up. And according to the book, the definition of an expense is an asset that is used up in order to earn revenue. And so what's going to happen here, and let me get here in the chart, is in transaction G, our supplies decreased by $800. And we had to solve for that number. We had to say $1,350 minus $550, what was left over, to get $800. And when an asset is used up to earn revenue, then we can call that an expense. So we can put that here, and remember to put the minus sign in Cengage for these expenses on the chart in Chapter 1. In Chapter 2, the minus signs go away. We won't use a chart like this, but for now, just do your chart in the problem, just like we're doing right here. And then we have transaction H. It says on November 30th, Chris Clark withdrew $2,000 for personal use. Well, Chris Clark got money out of the business. That means that we are the accountants for the business. So we wrote a check to Chris Clark for $2,000. So I'm going to put minus $2,000 because our cash decreased. And when the owner takes out money, that goes through Chris Clark drawing account, which is also a minus account in this chart because it's going to go against the equity. It's actually a contra equity account because it's going to go against. When you look at the whole chart, it's going to mirror what you see on this next slide, which is the summary of transactions for Net Solutions. This is for the whole month. These are all the accounts and the account balances at the end of the month. We're going to use those balances to create the financial statements in Part 3 of this Chapter 1 lecture. And here, once again, it's showing you what happens to owner's equity. Revenues are going to increase owner's equity, the capital account. Expenses will take away from that. And the owner's withdrawal will also take away from that. And here's our example exercise. This is going to mirror your practice exercise homework. So I want to go over this just so you see how we're supposed to do the homework. It says receive cash from owner as additional investment, $35,000. And so what you'll do here, I think you can see where I'm typing here, is the asset cash is going to increase $35,000. And then you'll know that the owner's equity account capital will increase $35,000. That would be the answer to part A. Paid creditors on account. You know that the asset cash will decrease $1,800, and you'll know that the accounts payable, oh, that's a liability. Accounts payable will decrease $1,800. Number 3, billed customers for delivery services on account. This is fees earned on account. You've done the work, but someone has not paid you yet. So what's going to happen there is you'll have an asset called accounts receivable. That's going to increase $11,250. And then you'll have fees earned, which is, revenue. Fees earned for $11,250. And if we look on the next slide, it'll actually show you the answers a little bit better. On part 3, you'll see the answer is actually the asset accounts receivable increases, and the revenue account that they're going to use in this example and also in your homework is delivery service fees increases by $11,250. In the